QuickBooks Online 2025 Delayed Credit Form. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for QuickBooks Online Test Drive, the free sample company file available to everybody looking for a result that has Intuit.com in the URL, Intuit being the owner of QuickBooks. Choosing the United States version of the software, verifying that we're not a robot. Then I'm going to close this first tab because it is no longer needed. That should bring us into our sample company file, Craig's Design and Landscaping. Opening up the major financial statement reports like we do every time. The reports, they're on the left-hand side, as we know. We're going to be right-clicking on the favorite balance sheet report to open it in a new tab. Right-click on the profit and loss, also opening it in a new tab. Go into the middle tab up top, closing the hand boogie, changing the range to a 2-year time frame. 010124 tab, 123125 tab. Dropping down for the years so I can run it, showing 2024 and 2025 side by side. Let's go to the tab to the right. Ultra Vase another time, doing the same thing on the range. 010124 tab, 123125 tab. We want the years and run it to refresh it. Nothing's currently in 2025 except for that $34, including prior presentation transactions, because we refreshed the sample file and opened in incognito window, which I suggest you do as well. So we're basically on as close to the same page as can be possible. Let's go to the first tab now, selecting the drop down. We've been looking at the revenue cycle, the sales cycle, the accounts receivable cycle, the customer cycle, and we've looking at some of these forms that are a little less common, hopefully, but we want to know what they do, including the credit memo, which is possibly the most common of these types of forms, where someone returns the merchandise possibly, and we want to give them a credit, reducing the accounts receivable, or possibly crediting their account for a future purchase, which we will talk more about shortly. We have the refund receipt, in which case it's basically a check form, but it's going to tie into, it's kind of a mix between the check form and the credit memo, reversing the transaction of the sale, but also issuing a check. But instead of having the expense and check forms, which are tied to vendors, it will be tied to the customer center, which is useful. And now we're going to do a delayed credit situation. Now, this is possibly the least common transaction form that we've looked at thus far. And I've seen it kind of used what I would think like incorrectly when I've looked around on people, like how they use this particular form. And so we want to think about when we should basically record a transaction and how it's going to be recorded when we think of whether we should use, say, a delayed credit form, a credit memo form, or possibly a refund receipt type form. All right, so let's go over to our flowchart and think it through. This is a desktop flowchart. We're in QuickBooks Online, but I'm just looking at this nice arrowed flow so we can think about the process that would happen where we might use this form. So if we have our sales transactions, you will recall we might have a situation where we record the sale with a deposit form. But more likely, if we have a full service system in a situation where we might more likely use a delayed credit form, we would be making sales at a cash register or possibly using an invoice. If we sell something at a cash register, then we collect the payment at the point in time we make the sale typically. So what if they return the merchandise, or if we're at that movie studio or whatever, we're at the movies and we sell a movie and they say it was terrible, and they want their money back or something like that. Well, at that point in time, we could either issue them their money back, but we can't really issue a credit memo because a credit memo decreases accounts receivable unless we wanted to say, hey, look, we're going to issue you a credit memo crediting your account so that you can come back and basically get a free something at some future point, a free movie, for example. If we have an invoice type of situation, that means that we're going to first do the work or ship the goods or services, invoice the client, and then if they come back to us before they pay us, meaning accounts receivable went up, we haven't yet received the payment, that's when the credit memo makes most sense, because that would reverse the transaction basically almost exactly, except we might change where that sales side goes to the allowance account, as we discussed in prior presentations, and we have the issue of whether or not inventory should go back on the books or not. But if we invoice the client and then we receive the payment, we're at a similar point as though we were at a cash register. They already paid us. And so that's what we're going to imagine in this situation. They already paid us. And now the question is, if they return the merchandise or we want to give them some kind of benefit in the future, how do we do that? Well, one way we could do it is we can give them a credit memo, which will basically give a negative accounts receivable in their account, recording the transaction at that point in time. Or we can have this delayed credit situation. Now, the difference with a delayed credit situation is that it doesn't actually record anything at this point in time. It doesn't record it until they actually take you up on the offer. So this, I think, might be a situation where, for example, if you're giving out coupons or discounts, if you're saying, I'm going to give you a credit for some future purchase, however, you're not sure how many people will take up that credit. So you might be saying, out of all of our clients, we're going to give a certain people a credit as a discount or something like that and allow them to have a purchase, but we don't think many people are going to take that up. And therefore, it would make sense possibly not to record it at the point in time as a journal entry, recording it as a delayed credit, giving them the option to take us up on it, but not recording it at the point in time they have the capacity to take us up on the offer, as opposed to if I issue a credit memo, at which point it's going to record it at this point in time, whether they take us up on the offer or not. So let me let's see the difference between those two types of transactions. So if I go over here and we say, all right, let's say that we had a sales receipt. Let's say sales receipt, a transaction recorded basically at the cash register. We're going to get paid at the same point in time we do the work or provide the goods or services. This is going to be customer number one again. Customer numero uno is back. This is our best customer, customer number one. We call them number one customer. All right, so they're going to pay us with cash, we'll say. We're going to put it directly into the checking account for our example purposes this time. We're going to make a new inventory item once again, which is going to be inventory item one. I can't type, my fingers are too fat. This is once again our favorite inventory product, inventory item one. People love it. We've been selling it like crazy. We're going to put 10 on hand, which will record the transaction, putting them actually on the books, 10 of them on the books. Reorder point, let's just say 0. Once they get down to 0, inventory account, we're just going to say that's going to be the increase when we buy it, decrease when we sell it. We're selling it here, although we're putting that 10 units on the books at the same time. And we're going to say we sell it. Let's just put the good old $100. And the sales account's going to be the sale of income, product income. We're going to apply the sales tax just to make it a little bit more complicated. And the cost, let's put it at the good old 70 as we did before. And cost of goods sold is the expense account when we sell it for the sales side of things. Let's save it and close it. So there we have it. Saved it, closed it, there we have it. So once again, it's doing that little glitchy thing that it's been doing lately where it's recording the sales tax, but it's not putting it in the total down here. Let's save it and close it, and then I'll go back into it, and it should properly do that. Again, I think it only does that over here on the sample company file, not in the actual company file, because I don't know why. It's a little annoying. Sales tab, let's go to the customers. Let's go to customer numero uno customer, our best customer. We call them number one. We just call them number one. Let's edit this one. Let's close that out. Let's go ahead and edit this form and check it out. So what happens with this, we're going to say the cash is going to go up by 108. The other side's going to go to revenue for the 100. Sales tax payable is going to go up by 8. And inventory is going to go down by the, what did we say, $100 or $70. Cost of goods sold is going to go up by 70. Net impact on net income 100 minus cost of goods sold of 70. And the subledger for inventory is going to be affected, tracking not only by dollar but by unit on a perpetual inventory method. Let's check it out. Let's close it and see if that is indeed the case. Go into the balance sheet, running the balance sheet, going into the checking account to check it out. And we see in here it's not recorded yet. QuickBooks is being glitchy. Let's go back. Record it, QuickBooks. I see there's a difference here. Why isn't it in the sublet? There it is. There's 108. And then we're going to go back up and say the other side's on the income statement. Run into refresh. Scrolling down, there's the $100 on the income statement. The difference back on the balance sheet for the sales tax payable at the $8 and the Board of Equalization. We're paying it to the state. The state does nothing. The whole state of California is burning down as I speak. I'm going to go back, and the QuickBooks isn't working, probably because it's located somewhere in San Francisco, California or something. It's broken too. Everything's broken around here, I tell you. Anyways, we're going to go back into it. We'll go into this one. There's the $8. And let's go back. We've got the inventory. So we'll scroll up to the inventory. It's going to be impacted. We put the 10 units on the books. And then we sold one of them. Once again, the one that's being sold is not showing up. Let's run it again. And let's go back into it. Otra vez. There it is. There's the $70. That makes sense. And then let's go back on the cost of goods sold on the income statement. There's the $70 there. We'll also track it on the subledger for units of inventory by right-clicking on this tab, duplicating it, and then we'll go into the reports on the left-hand side. I'm going to type in the good old inventory valuation summary. Inventory valuation summary. Close up the hamburger. Put that top bun on the burger. We put 10 units on the books. We sold one. Left with 9 units of inventory item 1. We've got a total of $1,226.25, which should tie out to what's on the balance sheet, $1,226.25. Going back to the first tab, we see our customer, and there's the amount here. Now, let's imagine that they return the merchandise. And so our option is, well, we could issue them a check as we saw last time, but let's imagine we don't want to give them a check. We want to say, hey, look, we will reverse the transaction, but we'll give you a credit. We're not going to give you any money, but you can come back and purchase something in the future. So we'll record like a negative accounts receivable. So that means we're going to issue a credit memo even though we already got paid. And that's going to make a negative receivable that they can take us up on later if they want to purchase something. So we're going to say, all right, let's try that. Let's check it out. So I'm going to go plus. I'm going to issue a credit memo even though accounts receivable had already been paid. And I'm going to say this is going to be for customer number 1. Customer numero uno. And we're going to say this happened, let's say on the 10th. And this is going to be for inventory item 1. And so there it is. It's not recording the $8 once again, but let's go ahead and save it and close it and then go back into it and it should record it. So there it is. And then, so let's go back into it here. Boom. And that's the sales receipt. Here's the credit memo. Let's go into edit. Boom. Okay. So what's this going to do? It's going to basically reverse the transaction, but to accounts receivable. So now we have the 108. What's that going to do? It's going to increase it's going to reverse the accounts receivable. It's going to decrease the accounts receivable, but the accounts receivable is at 0 for this particular customer, which means it's going to make a negative accounts receivable, which isn't actually correct because it should be, you would think, a positive liability, because a negative accounts receivable would mean that the customer owes us. I mean, that would mean that we owe the customer money. And typically accounts receivable being an asset means that they owe us money. So it's not exactly right, but it works beautifully from a bookkeeping standpoint because I can see it in the subledger for the customer in the detail, and then I can apply it out to a future sale with an invoice in the future. So that would be the idea. So we have the 108, it's going to be a negative accounts receivable, and then the other side is going to go to sales, and then we're going to have the difference to sales tax, and then the inventory is going to go back on the books and the cost of goods sold is going to be reversed. Now, if we want this to go to sales returns and allowances, I could do the same little trick we did with the credit memo, which means make another item go into sales returns and allowances and keeping the first item as well, but removing the dollar amount so it still records the return of the merchandise. I won't get into that now. Let's go ahead and save and close it. And just to check out what this does and what the difference is to the delayed credit, which we'll do next time. So now I've got the sales receipt had already been paid, and then I've got this credit memo, which isn't really, in essence, tied to the sales receipt in particular, because it's basically ending up with a negative balance. So now we have this negative balance that we can apply out to the future here. So let's check it out. If I run this, what happened? We're going to say that the accounts receivable, if I go into the accounts receivable, we've got this negative amount in the accounts receivable. It should really be a liability. So it's up here in the assets. Technically, from a reporting standpoint, you would think it would be down here in the liabilities. The other side went to the revenue. So let's run the revenue again, and revenue went back down to 0. So that makes sense. Back over here, the Board of Equalization went back down to what it should be. So it's at the same number again. So it went back down. And then the cost of goods sold on the income statement is back down to 0. And then the inventory is has been reversed. So if I go into the inventory, you can see it's been reversed here with the credit memo and the subledger for inventory. If I run it, we should be back up to 10 units. Hold on a second. I need to go up a few days and then run it. So now we're at 10 units, 1,296.25 on the balance sheet. We have the inventory, 1,296.25. All right, so there is that. Now, then what could happen in the future is they can buy something that we can apply to the credit, right? So we have a credit. So let's say they buy something in the future. We edit, and then we invoice again, and they buy something for customer number 1. Customer number 1, say this happened on the 11th, and once again we're going to put product or inventory item 1, and so they're going to buy this, and I'll record it and then apply out the credit to it that's already been recorded, right? So I'm going to say save and close, and so there we have it. And then notice what happened here is it automatically then recorded the payment. So the payment, because it connected the two out. So I had the credit memo, the credit balance has now been tied out. So if I go into the payment here form and edit it, you can see instead of us receiving the payment like we normally would, and we would record the cash that we receive or the check or whatever, it checked it off to the credit memo, so it tied out the payment. So now we have it. So now they purchased something in the future, and now their balance is back down to 0. So that's going to be the idea. If I look at the credit memo now, it's been applied. The credit memo has now been applied, and the invoice is now marked off as paid. Those two are connected with this payment form. All right, so that's the credit memo idea. Let's do a similar transaction, but let's think about a delayed payment type of situation. So let's start off with the same kind of idea. Let's say we make a sales receipt, and we're going to say this is going to be customer number 2, our second most popular client. And we're going to say this is happened on the 14th. Let's say that they pay us cash. It's going into the checking account for the inventory item 1, which is that's what we sell here. That's our main thing. So this is going to do the same thing. It's a sales receipt increasing the checking account for the sale for the 108, even though the 8 isn't being calculated right here yet until we record it. The other side's going to go into revenue for 100, sales tax payable up by 8, and then the inventory going down by 70, cost of goods sold going up by 70, and the subledger for inventory going down by the unit of inventory of 1 unit. Let's save it and close it. And then let's go into the sales tab again, into the customers, and customer numero dos. And there we have it. So there's the customer. Now let's say that they return the merchandise. And so now our option is, well, I could give them the money back, right? But I'm saying, no, I don't want to give them the money back. What we'll do is we'll give you a delayed credit. We'll give you a credit in essence so that you could purchase it in the future. But let's imagine that we're not confident that they're going to do it. We don't think they're going to do it. It would be similar to like giving a coupon out. And we're saying if the likelihood of them taking us up on the offer is low, then maybe I shouldn't record it at this point in time. So from a generally accepted accounting principle kind of concept, I believe the idea would be if I think they're going to take me up on the offer, then I should record it now so that I can record the transaction at this point in time. But if it's unlikely, if it's less than 50%, let's say likely that they take us on the offer, maybe I record it so I can see, the bookkeeper can see they have the capacity, but it's not going to be recorded until they would take us up on the offer. That's why it's a little bit unusual of a form. So let's do the delayed credit. So let's say we have a delayed credit now for customer number 2, and let's say that happened on the 16th, and we're going to say for the product, let's say for inventory item 1. Now it's a little bit more sticky in terms of us having to assign this credit for a particular item, in this case inventory item 1, when we process the transaction in the future. Sales tax is here. Notice the sales tax isn't being calculated down below though. We don't see that $8. Why? Because we're not actually recording the transaction right now. We're going to record it if they take us up on the delayed credit, right? So this will not actually record anything. No impact on the financial statements, which is funny, but it will show on the subledger. So if this customer comes in, then we can say, oh yeah, I see it there that we made you this offer, this coupon or something that you could possibly take us up on in the future, right? So then I could say, all right, let's save and close it and check it out. Nothing happens to the financial statements, but in here, I see I have this open amount that I can create an invoice with. So now I could say, okay, so again, the point here is that nothing happened over here, right? I didn't, no sale or no reversal took place. I still have the sale of product here. Here's my sale of product. And if I go into it, it's still still on the books for that sales receipt. It didn't reverse it with the delayed credit. Not yet, right? Not until I actually process the delayed credit after they take us up on it. So let's do that. Let's go back up and say, okay, so then I'm going to go back on over here and say, now we're going to take us up on it. So now customer 2 comes in and says, okay, I want to apply out this delayed credit for, and we have to be more specific about what we offered it for, because it's going to, I can create the invoice from that credit. So maybe we sent out coupons to a certain amount of customers as a promotional thing, and we don't think that a lot of them will take us up on it. That's why maybe we don't have to record it at the point in time we give out the coupons or the free thing or whatever. And then when they come in, that's when we record the transaction, right? So now we're going to say, okay, he comes in and we're going to record it. Customer 2 is like, I want to take you up on that. So we're like, okay, so now the invoice is being created. Let's say this happens on, let's say the 20th. And it's already been populated, and now it's recording the transaction. Notice what it did. It pulled in the negative amount in the line item up in the invoice of the form instead of basically connecting it with the receive payment form. So then I can put down here that I have inventory item number 1. So we're going to sell inventory item number 1, and then it's applying out the credit against it, balancing us back down to 0. So you can see a little bit different format on how we're applying this item out. The delayed credit being applied out within the line item here, whereas when we had the credit memo, we had the credit memo separate from the invoice, which was tied together with basically the payment form. Now, this method of doing this is still a little bit tricky because notice you can imagine that they apply the credit to something other than like inventory item 1. And if you buy something for a lesser value, then the delayed credit might be a little bit messy. I don't think it's not as easy to say, oh, I'm going to apply 50 amount of a 50 to here for a $50 purchase and still have the rest of it to apply out later. I think you basically are going to want to basically buy something of greater or equal value in essence to properly apply this out. So in this case, we have, of course, equal value. We're going to say or imagine that we said we're going to give you item number 1 in the future if you want it. If it was a coupon type of situation, that might be the idea of it. And then if I save and close it, here we have it. So now we've got the credit that has been input and then the invoice. So this is a little bit not as nice to look at, in my opinion, as the credit memo, because again, the invoice is showing a 0 amount because it was applied out in the invoice itself, instead of having it applied out where the invoice would record the sales transaction and then the payment being linked together, which would apply the credit out with a payment. In other words, you would think with the credit memo, we had these two forms and then a payment form linking them. Here, we've got the invoice, which is kind of netting out within the body of the invoice. But we can see it's been converted and we can see it's been paid, and that will then record the transaction. So we can then run up top. So then if we go into the accounts receivable, we go into the AR, we're going to say then here is the invoice that has been recorded. Again, it's kind of netted out against itself. So basically you ended up with nothing being recorded here within the credit. If I go back on up and I go to the sales side of things and we run it then on the sale of product in 2025. So it's showing the transaction here for customer number 2. And notice what it's showing is we have the same invoice number, 1042. We've got the invoice increasing as we would expect and decreasing. So it's showing the detail of the transaction and the credit being applied basically at the same time here. So if I go back on over, the other side's going to the Board of Equalization. So sales tax payable. And here's our invoice customer number 2. Similar kind of concept where now it's netting them out at 0. And so then I'm going to go back on up and go back to the inventory. So now inventory, going into the inventory for customer number 2. And we could see it's doing the 2 transactions for that one invoice form, netting the 2 out against each other. And so let's go back and let's go to the profit and loss again and go into cost of goods sold. Cost of goods sold. We've got the 2 transactions here, netting out the 70 and the 70, making it go back down to 0. And then if I go into the subledger for inventory, we are down to 9 units. So now we've got the 9 units in the subledger, and the subledger's adding up to 1,226.25. If I go to the balance sheet, we have on the balance sheet, well, it's not right because I have to increase the date on the subledger. Let's bring the date up on the subledger to the end of the month, run it again. All right, so now we have 8 units in the inventory. And so now we're at 1156.25. If I go back to the balance sheet, we're at the 1156.25. All right, let's go back to the first tab then. So again, I would be very careful with this delayed credit thing. I don't think it's the typical kind of form that you would use. But again, if you wanted to record something like you gave someone an offer, but you don't think they're going to take you up on it, and then you could possibly allow them to take you up on it and not record it until they do in the future, then that might be the case. Otherwise, I think it's easier from a bookkeeping standpoint to record the transaction when you give it to them, because that's when you're going to assume they take them up. And again, notice the difference here between it's recording everything in the body of the invoice, which is a little bit more messy to see. It's not as clear just from looking at it. as with a credit memo situation, if I go back into customer number 1, where you will recall that what happened is we have the credit memo and then the invoice, and then this payment form ties them together. The reason I think that's easier to see is because now you have the invoice shows the actual item that was sold instead of netting it out in the body of the invoice. And then you've got the credit memo, which is easy to see that those two match out. And then this one clearly tying those two together. If I edit that, you can see that clearly tied together. So although this one isn't perfect, because until they take you up on the credit memo, you'll have a negative accounts receivable, which means that if you want to report your financial statements completely correctly, you'll have to do a similar thing, as we'll talk about when we talk about unearned revenue, where we have a similar problem, meaning you might do an adjusting entry at the end of the period to, increase accounts receivable and record the proper like unearned revenue or some kind of liability account for the outstanding, credit amounts. So it doesn't show a negative receivable for a particular customer. But from a bookkeeping standpoint, internally, I think this is the clearest way to see it, because it's tracking everything internally and I can see exactly what's going on basically at a glance of the forms, and all the forms are acting like you would expect them basically to act. It's just a little bit backwards, where we have the credit memo happening and a negative accounts receivable before we apply it to the invoice. Okay.